I'm going to say this without a stutter. You will not meet a more selfless individual in your entire life.
One of the things that is super important about this profession is communication.
I think financial planning fees are going to moon, if you will.
I look at running a marathon very similar to a person's 401k.
For any of those aspiring advisors out there, where you are may not be where you end up, and that's perfectly okay.
I love that.
All right, John,
Morning, Tyrone.
how are you?
Good, thanks.
Thank you for joining me on this episode of Q and A.
Yeah, I appreciate you having me in the studio today.
Good, absolutely. Well, lots to cover. We were chatting it up before filming on so many different topics.
Yeah.
We'll definitely get to the question, which also, we can shake it out. We can shake it out. So let's do this. Tell everyone a little about what you do, how you do it, why you do it, and then we'll jump into the question.
Yeah, my name is Jon Burkett. I'm a senior portfolio manager with Exencial Wealth Advisors. It's a national firm, and I'm focused on options-based portfolios. So I do things like income generation, downside protection, that type of thing.
Okay. So for folks that may not, now this is for advisors, right? Now
Sure.
there may be clients watching or whatever. So
Yep.
that's an important thing. I remember from my Merrill days, right? Covered calls, right?
Covered calls
That's
are a
big
great
one,
tool.
right? Income generation. So let's
Yep.
talk a little bit about some of the like who do you work with, right? And why do those strategies work for them?
Yeah, so one of the groups of clients that I work with are folks who have built up concentrated stock positions in a single asset. So they might be executives of the company, or we have people that, they just loved Apple and kept buying it over years and years and ended up with a really big position. So how do those people manage the risk? Obviously, once the position becomes, a large chunk of your portfolio, anything over 10% really would be considered concentrated. But especially when you get to half of your portfolio in a single stock, that is a very, very risky thing to do.
Yeah.
So trimming down that position can often make sense, but we want to do it in a tax conscious way and maybe trim it down over the course of several years rather than taking the tax hit all at one time.
Got it. Now, again, I remember when I was studying for the Series 7, right? Like all of the guys before, they'd be like, make sure you get options down. If you don't get options, you won't pass, right? What are some things that you feel like, one, are underappreciated with options, and two, what do people get wrong, right?
Yeah, I think one of the things that people get wrong is on the income side of things, option income is not guaranteed. It's not like buying a bond fund where you're locking in a preset rate of return. The income is highly variable and it can be very attractive. And especially when the interest rates on the fixed income side of the house were pinned at zero for most of the last decade, it was a great tool to help augment your retirement income. But the other thing that people maybe look at the wrong way is, do you even need income? It's a very popular category. Income funds sell like hotcakes, but not everybody needs income, especially when you're still in the accumulation phase of your investing life cycle. Really, you might want to focus more on growth.
Right. So staying with that and kind of leading into the question here that you will ask.
Yeah.
So working with advisors, right? And I forget what the study was, right? There are a lot of resources and tools at advisors' fingertips, right? So many different things to use.
Very much so.
Right? And if we're being frank, lack of understanding about some of these things, right?
Yeah.
Do you find that amongst advisors, option strategies and hedging strategies are over or underutilized?
I would obviously say underutilized,
Really?
but I think they're not well understood even by professionals.
Okay.
The number of people that are trained to understand the strategies is low. The traditional advisors still don't make much use of options, which I think you're leaving a lot of potential on the table there.
Right. And also, I think, and we were talking about this, right? I think business models play into that, and a lot of different things as to why they don't. But so it's easy to kind of, if you can get it somewhere, right, set it and forget it, do what you know, to kind of break away from that. But I've heard, right, the advice, and so as I was talking to you before, I was at a large team at Merrill that utilized those strategies and well. They did it very well and made clients very happy. And it was mainly with folks who just had very ridiculous concentrated positions, right? And kind of convincing them, hey, this is how it's a way to diversify, right?
I'd love to see it more widely used also by people who are in that final few years before retirement or in that first decade after retirement to manage the sequence risk.
Okay.
Because if you've spent your entire life saving up a nest egg and your portfolio is at its peak value, and then you hit a nasty market drawdown in that stretch with no future income to keep dollar cost averaging in and lowering your average basis, it's a really it's really not a good situation to be in.
Yeah, so we're right. I'm throwing you a fat pitch down the middle here. So sequence risk, right? For those that may be watching and really don't understand that, what is that?
So it's essentially the role of luck in terms of, the best case scenario is that while you're working and putting away assets, stocks and bonds are trading at very low valuations, and every dollar that you put into the market is buying you a lot of future potential growth. But then when you retire, ideally valuations would rise exactly when you're selling down your portfolio.
Right.
But if you get the opposite path, where you're accumulating during a high valuation period, and then you retire and valuations reset back towards the mean, then you might have a potential problem and risk blowing your financial plan. So managing that risk and smoothing out the return stream is what options can really help with.
All right, well, let's get to why we're here, right? So we're gonna double fist pump it out before we get started. So I know there's a lot of context and nuance around your questions, so shoot, let's chop it up.
So historically, investing in stocks was the preserve of only the wealthiest Americans. You needed access and information, and really not everybody had the money to invest. But now, I can know the financials of every S&P 500 company and do option trades with margin on my phone while walking down the street to work. So the environment has completely changed. The other thing is, in the 80s, 90% of people had a pension to rely on. And now the vast majority of Americans do not have that. We've shifted to the defined contribution rather than the defined benefit. So there's, are we betting too big on the stock market? Are we, over relying on that as the driver of our retirement plans?
So much to pick apart there. The first thing I will say is right away when you mentioned the stock market and being available to people, right? There's a stat that just came out. The bottom 50% of Americans own less than 1% of equities. That is astounding, right? Especially as we sit here at Nasdaq. That is astounding, and something that needs to change even with all of the accessibility there is, right?
It's very true.
I speak to a lot of kids and educate them, and one of the things that I tell them, there's a few apps that already come preloaded on your phone, and one of them is the Market app, right? That's already on your phone for a reason. Because Apple is marketing to an audience, right, that is very savvy, very wealthy, obviously, right? And they know that that's important to those folks. So I hope that this show and other realms will bring more people into the market, which leads me to this point, right? Defined benefit. My dad has a pension, and folks of a certain age have a pension, and they're just kind of sitting back. The stock market now, tied with defined contribution plans and 401ks, it gets tricky, especially as there's these demographic shifts that are happening, right?
Very much so.
Which we spoke about. Folks are living longer. What does retirement look like in the future? Planning software only going up to a certain point. Portfolios are going to look different in the future than they are right now,
Certainly.
right? I make no secret I'm a huge crypto hippie, right? Probably a bad time after the last week. But even if it's other alternative assets, right? You're seeing a move to that. So I think, again, and we were having this conversation, that 25, 35, 45-year-old right now, looking at a 401k, we've gotten questions from clients like, does it make sense, right? I definitely should invest, but is this the right vehicle? And it gets controversial, especially on FinTwit and social media where, a lot of advisors go back and forth, but I'll just say it. I have conversations with clients and say, you know what? I don't know, right? There may be an opportunity where you can do some other things, right? I think Roth IRAs are completely, underutilized.
Very much so.
There may be a lot of different things, because as we're saying, right, as you reach your peak earning years, right, your 30s and 40s, and you get into your 50s, it's also very high expenses, right, out the other end as well. And as we were saying, you absolutely should invest. But whether a 401k makes sense, highly debatable. But I'm on the side where I just don't think it's, oh, you should just do it and set it and forget it.
Yeah.
I think it's something that as advisors talking to a client that is just starting a job and they're 25 or 30 years old right now, is that something you really, it's just, just absolutely do it. Something I think it should be on the table for conversation.
There's so many assumptions that go into financial planning, right?
Yep.
Your plan, you're estimating a future expected rate of return. And what if you just don't get that?
Yep.
So, our answer traditionally has been diversification. And, if you hold a portfolio of assets that includes different asset classes, different geographies, you're more likely to meet your goals. And that's why, those concentrated positions can be so risky because you're very overweighted in a particular asset and, it may not pan out.
Yep. So a couple of things to that. The other side of that now, right? You get into a company as part of the package, right? And the free money, if you will, of them, matching contributions and all that. It's hard to say no to that. But I think if you talk to any HR person, there's a lot of people that tap their 401k way too early and way too often, right? So I think that's something that, and the data proves this, right? That there are a lot of people, that take loans against their 401ks. And again, it may not necessarily be a bad thing if you're buying a home or something like that and you're going to replenish it. But a lot of people are just doing it to get by, right? I actually was having a conversation yesterday with an individual that tapped the 401k too many times and tapped it recently because they need to make a higher rent payment every month now.
Yeah.
Right? That's not what a 401k is for.
It's not.
And then if that money was not in that account, you don't have the penalty and so on and so forth. So you definitely get, the smack on the, the hand if you go to touch it, right? The cookie jar is supposed to be for later to take care of needs of consumption of things right now. So very delicate balance from a planning standpoint.
Very much so. And, we were talking about safe withdrawal rates. Even if you save and invest and you've got your nest egg and you never touch it and you don't have those emergency expenses come up, traditionally 4% is viewed as a safe withdrawal rate.
Yep.
And in the US, especially post-World War II, you might have been able to get away with as much as 6%. But if you look at international markets over a longer time period, that future safe withdrawal rate, it might be as low as 1 or 2%.
Wow.
So there's a wider range on that number than I think people really understand.
Yeah. And I think that's the thing here. We were talking about this as well. You said you use, e-money for your planning.
We do.
Right. And planning tools now, the other thing I mentioned was assumptions, right? Advisors are just putting in a bunch of assumptions.
That's really what it is.
Right?
Yeah.
You don't know, which is why I think planning or financial plans have to move with the client, right? They should always constantly be updated.
Very much so.
Right? For a lot of different things, right? And a lot of different risks that aren't on, your advisor exams or designations, right?
Yeah.
It's like real life that you don't really account for.
That ongoing dialogue with the client is critical because, you lose your job, then what? How does your financial plan change? And if you're not updating it on the fly, you can get into difficulties.
Yep. And I think that you nailed it. And I think that right there is the gift and the curse right now, right? The gift is an opportunity for a younger advisor or advisors that are willing to adapt to say,
yes,
planning cannot go the way it was going before. Maybe we've gotten it wrong, right? And there's a phrase that a friend of mine, Emlyn Miles Mattingly says, right? Financial advisors are really good at getting the numbers right and the people wrong.
Yeah.
Right? It's time to start getting the people right.
Yeah.
And that is real-time planning. That is the ability to update your plan as you go, right?
And there are such a wide range of clients. Some folks that we work with have a risk tolerance that's off the charts. They just want to swing for the fences every single time. And other folks are, they'd rather sit in cash. And that's equally risky.
Yeah.
So you're constantly guiding clients away from extremes and back towards a more reasonable middle path.
Yeah, exactly. And I think folks come to their wealth differently. They come from different backgrounds. They get to a point where now they may be working with an advisor or they may have money, but there's a particular way that I want to work with this advisor. And
Right.
you can't just bucket everyone into the same type of advice because it fits your technology, right? That's not going to work. And I think the other thing, as far as 401ks are concerned, which is an interesting thing as well, if you look at Gen X, right? The forgotten generation, if you will.
That's me.
Right? The forgotten generation, if you will, that are going to inherit and save and invest more, right? Over the next, I think they said over the next 5 years than millennials and boomers, right? But 401ks are a big piece of how their wealth was generated and what, retirement looks like. So I think it's a much different conversation with them. Lots to pull apart here, but I think the main thing is, as you mentioned, it's all assumptions, and advisors need to be able to adjust on the fly.
They do, and any tools that we can bring to bear to sort of narrow the range of outcomes. We don't need necessarily to have that extreme lottery winner type of outcome.
Yeah.
And if we can give up some of those, that extreme upside potential in order to cut off the left tail of very bad outcomes, that can be a really useful way to sort of craft a process.
I love that. Narrow the range of outcomes.
That's right. Consistency is king.
Yes, it is. Consistency is king in all things, but especially in financial planning.
That's right.
Well, thank you so much for the conversation, man.
Yeah.
It was awesome again.
This was
Double fist
great.
Pump again.
Thanks for bringing me in.
Absolutely. All right. Thank you all for tuning in to this episode of Q&A. Be sure to find us on social media. Like, share, subscribe, tell one, tell another, share with liked ones and loved ones. See you all on the next one. Appreciate you.